let's break down today's market action with Hightower Advisors Chief Investment Strategist and CNBC contributor Stephanie Link and Innovator ETF's Chief Investment Strategist Tim Urbanowitz. Guys, good to see you. Stephanie, some volatile assets had trouble today. AI names like Palantir and NVIDIA, Dell, fintechs too. The Dow was higher, though. Meanwhile, S&P hanging out around 5,800 still. So how are you investing here?
Yeah, it's a lot to digest. I think you just have to put it into context that the last 4 out of the last 6 years, John, the markets, the S&P 500, up north of 20%. That is huge. Long-term total return average for the S&P 500 is 7.7%. So we're well extended over the last several years. We all feel pretty good about that. Fast forward to this year it's going to be a little bit more mixed. I think we're not going to see a 3% GDP growth like we saw the last 2 years, maybe 2.5%, which is not terrible, still above trend. But the point being is you just don't have that fiscal stimulus this year that you have had over the last several years. And as a result, a little less growth, maybe a little less in terms of earnings growth. I'm thinking mid-single digits, upper single digits. So I'm taking kind of this two-prong approach this year. Number one, I'm looking for strong sectors that actually corrected in December, 6-8%. That's financials, that's discretionary. And then I'm actually looking at some laggards to mean revert, and that's what we're seeing so far this year, John. Mean reversion into energy, materials, if you will, those kinds of sectors. And so that's kind of where I am adding to. I mean, like energy last year was up 3% in the entire year. So I think with higher oil prices, that should be pretty positive for that sector as well. So a mix. It's not all foregone for technology, but I think maybe we're going to see a little bit more of a broadening out.
Okay. Well, Tim, what role do you see interest rates playing in equities here, especially after that hot jobs report on Friday? How do they affect names like KB Home, which reports in just a few moments?
Well, John, overall, we think that equities can digest interest rates very well at the index level. I think it's pockets of the market, like KB Home, those builders that are really going to struggle with higher interest rates. We just don't think you're going to see a broad recovery in housing at this level. 7+% mortgage rates are much different than 6%. And I look at a name like KB Home, when you look at the pocket of the market that they're catering to, that first-time home buyer, they're going to be much more sensitive to that payment. So we think it's high risk, lower reward. So we want to look at pockets outside of that. We think the AI infrastructure trade is going to be alive and well. There's a backlog of orders, high margins, strong pricing power. Those are really the pockets that we want to be focused on right now.
Okay, Stephanie, I want to ask you about the consumer, and you mentioned mean reversion. Your long Gap and Target. We're about to get some great insight from Morgan's interviews this hour at ICR. Abercrombie had a terrible day. So did Macy's. What makes a good consumer play here?
Well, first and foremost, I think the consumer is in pretty good shape, and that ties to jobs. And we had a very good job number on Friday with decent wage growth. A little less than we thought, but it's still pretty high. And I think with a little bit lower inflation, yes, I know it's sticky, John, but it has come down dramatically from that 9% to 3%. Adding it all up, I think the consumer is in good shape. We know about the services story. The ISM services continue to hum. It's encouraging. But I also think maybe also, again, a little bit of mean reversion within consumer back to goods. And Gap has lagged, and Target certainly has lagged. Both are show me stories, but I just think that there are places where in consumer the risk reward is very attractive. I mean, you have Richard Dixon at Gap who fixed Barbie at Mattel when he was at Mattel, and he's been there a year and a half. And oh, by the way, everyone's talking about Lulu today and the strong numbers. Well, guess what? Athleta grew 5 percentage points sequentially last quarter, and they've got all kinds of new leadership at that company. And then Target, show me story, but I think they've gotten through their inventory issues. They still have to be more consistent, but I think they can get back to a 5 to 6% operating margin. So I want to be very selective within discretion, but I want to look for opportunities and stories where the fundamentals can absolutely improve.